the recent massive escalation in the Middle East, specifically the U.S. and Israeli strikes, including Operation Lion's Roar, which targeted those 48 Iranian leaders, and, of course, Iran's subsequent retaliatory attacks.
Right. And the central question we are trying to answer today is whether this current conflict, and specifically the disruption of the Strait of Hormuz, is going to trigger a systemic, long-term global economic shock. Or, and this is the other side of the coin, are the impacts actually temporary? Are they manageable due to, say, modern market buffers and alternative supply chains?
Exactly. And to be clear, this entire debate emerges directly from the latest financial and geopolitical reporting we've been seeing on the conflict's fallout over the last few weeks. My position on this is that the vulnerability of key shipping choke points, especially the Strait, is going to cause cascading inflation and expose some really fragile financial markets.
And I will be arguing the opposite. I'll be making the case that significant global supply buffers, along with modern market elasticity, will actually contain this economic fallout quite effectively.
Okay, well, let's just get right into it because I view this disruption as fundamentally structural. We are not just looking at a political headline. The Strait of Hormuz is essentially shut down right now. Following the attacks on those 3 cargo vessels, shipping volume through that corridor has plummeted by 70%. 70%. And we have to remember, this isn't just an oil crisis. It's a broader energy and agricultural crisis. We're talking about 20 to 25% of the world's oil, 20% of global LNG, including the halted production at that major Qatari facility we saw last week, and 30% of global fertilizer. All of it relies on this single 40-kilometer wide choke point. So the necessary rerouting of ships around the Cape of Good Hope, which is happening right now, is going to cause weeks of delays, and that drives up production costs across the board, cementing long-term inflationary pressure that we just can't escape.
Well, I hear the alarm bells, but I think we need to look at how the global economy actually functions today, rather than how it functioned in the 1970s. While there is definitely near-term tightness, the global economy is far better insulated than in previous decades.
Insulated how, exactly?
Let's look at the actual market panic. Initially, yes, we saw Brent crude jump 10 to 13%, but it has already moderated. It settled at around a 7 to 9% increase, putting it at roughly $78 to $79 a barrel. That is a far cry from the $120 per barrel spike that we saw during the invasion of Ukraine.
Right, but and let me just add, we have massive buffers in place. Global oil production is significantly higher than it was 20 years ago. Right now, as we speak, there are 90 million barrels floating on tankers worldwide, acting as a direct supply buffer. Furthermore, Iran itself only accounts for about 3 to 4% of global oil production. The market resilience here is tangible. Tangible, maybe, but I think it ignores the physical vulnerabilities of the infrastructure itself. We can talk about floating buffers all day, but look at the recent drone attacks on Saudi Arabia's iconic Ras Tanura refinery. You can have all the reserves you want, and OPEC can promise to increase output to cover shortfalls. But that promise is completely meaningful if the physical transport corridor is unnavigable. If the ships can't safely load and traverse the strait, the oil doesn't reach the market. The infrastructure is inherently fragile.
I agree the infrastructure is a choke point, but we have to question the longevity of the strait's closure. You are assuming this is a permanent or deeply prolonged state of affairs.
I'm assuming it's closed long enough to do real damage.
But look at the incentives. Iran relies on the Strait of Hormuz to export 80% of its oil to China. A permanent or even a sustained blockade works directly against Iran's own economic interests. They would be strangling their own primary revenue stream. History consistently shows us that in these geopolitical flashpoints, price spikes moderate very quickly once shipping safely resumes, and all parties have a vested interest in resuming it.
Yeah, but quickly in geopolitical terms can still mean months of elevated costs for everyday consumers. And that's where the rubber meets the road here. Let's detail the direct and cascading costs. The math on this is brutal. Every single $1 increase in crude translates to a 2 to 3 cent rise in gas prices. So if we see a $15 to $20 barrel spike, which is highly plausible if this drags on, that could raise pump prices by 30 to 60 cents a gallon.
Sure, the pump price mathematics are straightforward, but
But it doesn't stop at the pump. Increased costs for jet fuel, everyday petroleum products. We're talking about polyester, garbage bags, even lipstick. The inflation permeates everything, and this will force central banks, like the Reserve Bank of Australia, which is already under pressure, to hike interest rates even further. That is going to devastate household budgets that are already stretched to the breaking point.
I acknowledge the math, I really do, but your scenario assumes a worst-case, sustained $90+ per barrel environment. And frankly, the data doesn't support that assumption. Markets had already priced in much of the geopolitical tension prior to these specific strikes. This wasn't a total surprise to institutional traders.
You don't think a 70% drop in shipping was a surprise?
The magnitude, maybe, but the risk was priced in. Traders are already securing alternative suppliers. They're shifting cargo delivery dates. The market is adaptable. You mentioned the delayed shipping routes. Yes, going around the Cape adds time, but logistics companies immediately adjusted their pricing models and delivery expectations. The market is absorbing the shock, exactly how modern elastic markets are designed to do.
See, I think framing the financial system as capable of just absorbing this shock is overly optimistic. The financial system is incredibly fragile right now. Just point to the immediate market reactions. We saw the Nikkei and the Hang Seng drop over 2% instantly. We have tech companies like Atlassian down 80% from their peaks, partly due to macro instability. We literally saw the collapse of a UK financier last week, and major banks like Goldman Sachs taking 5 to 7% share price hits. This is financial market contagion. It's not just a logistics issue.
I have to firmly push back on the word contagion. What we saw was a standard temporary flight to safety sell-off, which happens every time missiles fly. It is not a systemic failure of the banking sector. Yes, airline stocks took a predictable hit. Of course they did. Regional travel is disrupted and jet fuel costs spiked. But overall, markets are keeping on, keeping on.
Really? Keeping on?
Yes. In fact, if you look at resource exporters or safe haven commodities like gold, they are actually benefiting from the current environment. Capital didn't evaporate, it just rotated. That is the definition of market function, not market contagion.
It rotates away from the consumer, though. That's my point. When capital rotates into gold and out of growth, or when logistics costs skyrocket, the everyday bullion economy suffers. To summarize my position on this, we are relying on incredibly fragile physical choke points in a highly leveraged global economy. The structural disruption to energy and agricultural lifelines is real, and the inflationary pressure it creates cannot just be hand-waved away by pointing to floating oil tankers.
And to summarize my stance, while the choke points exist, the stabilizing power of modern supply buffers and global production capacity is vastly underestimated. The initial panic has subsided because the market realizes that a sustained closure of the strait is economically suicidal for the very actors trying to close it. The elasticity is there.
I think the one area where we clearly converge, and the data supports this, is that the ultimate economic impact hinges entirely on the duration of this conflict.
Absolutely.
If this is a short-term campaign, like some political figures, Donald Trump was out estimating a 4-week timeline for the immediate kinetic phase. If that holds true, maybe the buffers hold. But if it becomes a prolonged regional war, all bets are off.
Right. A 4-week disruption is a logistical headache. A 4-year regional war is a paradigm shift. We agree on that threshold.
It really highlights the sheer complexity of untangling geopolitical conflict from domestic household budgets. I mean, the intricate web of global supply chains from Qatari LNG exports directly affecting local interest rates in Sydney or London, it offers so much material to explore.
It does. That shows how interconnected the whole system truly is.
Well, we've laid out the data and the differing market perspectives. As always, we will leave it up to you, the audience, to weigh the evidence and form your own conclusions. Thank you for joining us on this deep dive.
Thanks for listening.